Have you ever looked at a stock chart? It looks kind of chaotic, right? Like it's just bouncing around based on news, fear, greed. But what if it's not random at all? What if, buried in all that noise, there's a predictable rhythm, almost like an algorithmic blueprint for the S&P 500? Well, in this explainer, we're diving into a really fascinating theory that says that's exactly what's going on. So it all kind of boils down to this one really provocative question. We think of the market as this giant mess of human emotions. But what if the biggest players on the field aren't reacting? What if they're just executing a plan that was put in motion a long, long time ago? And here's the core idea from the source material. It's a bold claim that the market's biggest swings aren't accidents. They're actually the work of huge institutional programs and super powerful algorithms just running a pre-written script. So let's pull back the curtain and see what this so-called blueprint actually looks like. All right, so what is this algorithmic blueprint? What's the secret recipe? In this first part, we're going to define the core pattern that's supposedly pulling all the strings. Okay, at its heart, the pattern is a really simple but powerful two-step cycle. First, you get a big, predictable drop. They call that the correction. But that's just the setup, because right after that, it's followed by a way bigger surge upward, the rally. The whole theory is that this isn't just happening by chance. It's the signature of these algorithms doing their thing. All right, so let's dig into this two-step dance a little more, because according to our source material, it's not just that one thing happens after another. Nope, it's the specific size of each move that really matters. You can almost think of it like a 1-2 punch. First comes the jab, the correction. It's a sharp, calculated drop. And then comes the knockout blow, the rally. A huge surge that doesn't just get back what was lost, it blasts right through to new highs. The theory claims the first move is designed to set up the second one. So, how big is that first jab? Well, according to this theory, it's not random. The correction phase seems to consistently land right around this number, about 1,300 points. Keep that number in your head. And the rally that comes after? Well, get this, it's even more specific. That surge upward consistently measures out to about 2,600 points. Now, just think about that for a second. A 1,300-point drop followed by a 2,600-point rally. That is an almost perfect 1-to-2 ratio. That is the secret sauce of this whole alleged blueprint. Okay, a theory is one thing, but where's the proof, right? I mean, does this pattern actually show up in the real world? Well, the source material points to 3 different times in history where this blueprint has supposedly played out step by step. Let's start with what they call Phase 1. This is the first big example where this pattern apparently showed its face. And here are the numbers. So the correction was just over 1,200 points. That's pretty darn close to our 1,300-point model. And the rally that followed? A monster 2,608 points, lining up almost perfectly with that 2,600-point target. Coincidence? Let's see. So was that just a fluke, a one-off? Well, let's take a look at the second phase, because this is where the case starts to get even stronger. Just look at these figures. The correction was negative 1,319 points. I mean, that's not just close, that is unbelievably close to that 1,300-point model. And the rally? 2,636 points. Again, hitting that 2-to-1 ratio almost on the nose. This is the kind of consistency that makes you go, And that brings us to the most recent evidence. This is where this historical pattern smacks right into today's market and where things get really, really interesting. So in this latest phase, the correction was minus 1,302 points. I mean, you can't get much closer to the blueprint than that. And then, just like the pattern would predict, a massive rally followed right after. It's kind of wild when you see it all laid out. And this slide just puts it all together. When you look at the 3 phases side by side like this, the consistency is just striking. The corrections, 1205, 1319, 1302, all dancing right around that 1,300-point mark. And the rallies that followed, all consistently about double that number. According to this theory, this isn't luck, it's a design. So, okay, if this pattern is held true 3 times in a row, it kind of begs the obvious question, right? What happens next? If this blueprint is real, what does it tell us about where the market is going? And this is really the multi-trillion-dollar question at the heart of this whole analysis. Given this incredibly consistent pattern, is the market just reloading for another massive push higher? The logic here is pretty straightforward. Step 1, we just saw another correction of about 1,300 points, right on schedule. Step 2, a rally of about 2,600 points followed, just like the blueprint said it would. Which brings us to the huge question. Does the end of this cycle mean the next big move is already in the works?
Okay, now it is absolutely essential that we're crystal clear on this point. What we've just walked through is an explanation of a theory from our source material. We're here to show you a perspective, but this is not, I repeat, not financial advice. So we'll leave you with this thought. The point of this wasn't to give you a crystal ball, but maybe a new pair of glasses. The next time you see the market go wild, you might just ask yourself, is this really random chaos? Or are you just watching one small step and a much, much larger pre-planned dance?